Saturday, February 10th, 2018, Monaco 64, home of alternative economics and contrarian views. So could the Dow drop to 6,000 by March of 2019? Well, I'll show you why it's possible. Before that, let's go through some technicals. I want to start out with the US dollar, the dollar index. Dollar has kind of bottomed of late. The bottom was 22nd of January, the week of the 22nd. We got down to a low of 88.43. And you can see that we're consolidating right now, in my opinion. The trend still looks lower. You can see the moving averages. The 50-week is moved below the 100-week. And they're just about to, meet the 200-week moving average, which is the green line. So, yeah, the dollar could continue to consolidate here, even move a little higher like it did a few months ago there, when you see that it got back above the green line and then it failed again. So we could still have a few months of consolidation, or maybe weeks, but the trend looks set to continue lower in the dollar index. Now let's have a look at gold. Gold and silver, of course, have been frustrating, but it's always good to look at the bigger picture. I've got a weekly chart here of gold, and you can see that that upper trend line resistance is pretty much where gold hit a few weeks ago. In the week of the 22nd of January, we got up there to a high of 1365, and it failed to go through there. The dollar, of course, is well held, and that's why silver's come back down. But one thing that's encouraging is that the 50-week is now above the 100-week moving average, and they're both comfortably above the 200-week. So you need that in a bull market. And if you look at the lows since, gold made a low in the end of 2015, the lows have been higher. So we've had higher lows. And since we made the low as well at the end of 2016, we're seeing higher highs. So, yeah, gold could continue to consolidate or even go lower, but I think we're going to see good support above, maybe between 1260 and 1290. We could still go back down there, but gold still remains, in my opinion, medium term to longer term in good shape. What about silver? Well, silver as well has been frustrating. Look at the bigger picture here again. In a bull market, of course, we need the green line, which is the 200-week moving average, to be below the 50-week and the 100-week. And you can see there that from beginning of 2014, we've been nowhere close to that green line going below the shorter term moving averages. And now it's starting, now it's below. The green is just below the 50-week. The 100-week is still quite, is still the highest. Ideally, we want to see the 50-week go above the 100-week as well. But we're very close to moving, in my opinion. You can see there's a trend line. Silver, could still go a little lower, but I think, we're close to ending this frustrating consolidation that's taken a few years in silver and gold. What about the treasuries? Treasury yield, you can see the chart here. We're comfortably above now that 263 resistance. We had like a double top of that level end of 2016, beginning of 2017. So we closed the week at 285 in the 10-year yield. Last week we closed around 270 So it was a big spike in yields last week, about 15 basis points. The key resistance now is the high from the beginning of January 2014, which is just above 3%. It's actually 3.04. And it looks like we could be set to test that. Of course, we could still see a little bit of, choppiness, even, go back down to retest 263. But I think yields are on the way higher, just as the dollar is on its way lower. What about Bitcoin? Let's have a look at Bitcoin. First, I've got the daily chart. The 200-day moving average is just around 8,000. We got through there, but it's rebounded back above there. But in my opinion, the key level really to keep an eye on now, and the way I'm looking at this is by bringing the weekly chart. And you can see there's an overhead resistance there, and it comes right around 13,000. We need to get back above 13,000. Then we can say that the correction is over in Bitcoin and cryptocurrencies in general, because Bitcoin, of course, leads the way still. It's the kind of the, the leader of the pack. And if you look at the going back to the daily chart, if you look at the 50 and the 100-day moving averages, they're just below 13,000. So it makes sense if we get back above 13,000, it could be very, very bullish. I think that will mean that the bottom is in of this, very big correction we've seen in the cryptocurrencies and Bitcoin especially. So now, let's go to the Dow, because there's a lot of people, the Dow and the S&P, I think they were down about 5% this last week. So a big move lower, 5%. And there's a lot of question as to whether this is just a buy the dip opportunity, or is it the beginning of a major, ongoing crash. And the first thing I want to look at, though, is the Fed funds rate. And what's that got to do with the Dow? Well, I think what I want to try to explain is that since Greenspan took power, and that's around when the Fed funds peaked at 10%. You had the stock market crash in '87. And you can see that he brought the Fed funds rate down almost to 2.5%. I think it was just around 3%. And then he started raising rates. And then and raised it back almost to around 6 or just below 7 there before the 2000 crash or dot-com boom crash. And then he had to, after the market crash, he cut aggressively. I think at the time it was just 1% or just above 1. And then he started hiking again. And then Bernanke was around, but, Bernanke was just like really Greenspan 2. And so is Yellen. It's just a continuation of the same easy money policy. And you can see we had the crash, great financial crash of 07, 08, 09, it started in 07. And rates were taken down virtually to 0. I think it was 0 to 0.25% target. And we had QE, which is completely extreme. Unsterilized QE. By unsterilized, it means that the Fed's pumping money, but it's not taking money out from somewhere else. So it's unsterilized, trillions and trillions of dollars. And rates, stayed low. It's just recently that they started raising it again. And the reason I'm giving you this is because, the more extreme policy, got, the higher the market went and the bigger bubbles we had. So, and I think we could be at a juncture where the everything bubble that started from the low in '09 to the recent high of January 2018, at 26,616.71 in the Dow. It could be over. And before I go and look a little closer at the previous crashes, so we can extrapolate and see what kind of crash we could get, I want to show you a quarterly long-term chart, logarithmic chart of the Dow going all the way back to 1920. You can see that upper trend line. That comes around actually just below around 28,000, 27,000. So I guess we got up to almost 27,000, got up to 26,616. Could that be the reason why, you know, we reversed so strongly? Well, maybe. And you can see here there's a couple of trend lines on the downside. The first one is around 14,500, and the second one, which takes the low from 1929 and the low from, let's see here, 1982, that comes in around 6,500. So let's have a look at what the Dow did from January 2000 to July 2002. So January 2000 was the dot-com bubble high at 11,750.28, and then the market topped that month of 2000, and then it dropped and made a bottom in July of 2002 at 71,097.49. So that drop took roughly 31 months, and it was 38.7% drop. And yeah, and that's when Greenspan started cutting, and he cut it down to around 1.5. I'm not sure exactly. So that was the first time after the dot-com bubble. Greenspan, you know, put the, you know, his foot down on the pedal and pumped the gas and created the housing bubble, you know, the mortgage-backed security bubble, which you know, came crashing down under Bernanke's watch in 08-09. So let's have a look at the you know, the crash we had in 08-09 that actually started you know, with a top in August of 2007 at 14,198.1, and we made a low 20 months later, roughly, in March of 2009 at 6,469.95. So 20 months and a drop of 54.4%. So what I've done now is extrapolate January 2018, which is where we've had the recent high at 26,616.71, and the 20 months was 64% of the 31 months. So I've extrapolated, and you know, 64% of 20 months is roughly 13 months. So this, if it is a top and we're going to see a crash, it could be over 13 months. And if you look at the percentage drop, 38.7 and 54.4. 54.4 was about 1.4 times more than, you know, the 38.7. And if you do that to presently, it's roughly 76.46% drop in the Dow. Dow in 1929 dropped 90%. So where would that take the Dow? Well, I've got a number of around 6,265.57. So roughly around that trend line, that lower trend line, which is around 6,500 right now. It's going to be a little higher in 13 months, but not that much. And we could even, you know, breach that line a little bit and then, you know, rebound. You know, markets and charts are not perfect. They give you an idea where things could go. So am I saying this is going to happen? No, but it is a possibility in this fiat system that we've had, especially after Greenspan took over, because I think Paul Volcker would have been it would have been different under Paul Volcker. I think Greenspan was brought in to really goose up everything to start this big financialization. What does that mean to gold? Could gold go to 6,000 and we'd have a 1-to-1 ratio? That's very possible, and we could even go higher, and the ratio might even, you might even not need. You might even need like 2/3 of an ounce. It could go through that. Gold could go, to 8,000-10,000 while the Dow is at 6,000. We've never really seen that before, but in extreme markets, there are extreme events. Of course, silver would do really well as well. If gold was at 6,000, we could be at $200 silver if we have a 30-to-1 gold-silver ratio, or even higher. If you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. And you can also follow me on steemit.com, on Twitter, and on Facebook, Monaco64 on Facebook. So I'll talk to you later. Have a good weekend. Bye.